What I have for you this week is an interesting, simple but interesting case which brings in a lot into play where one wouldn't expect it, and it's about a Mexican owners owning a apartment in the Netherlands. The case is very recent, as you can see. It's from end of May 2022, and it is about Article 6, about whether the Netherlands can tax a deemed income from the own use of one's own property under the Mexico-Netherlands Treaty. There was no real income, there was only fictitious income, and the question is, can this be taxed? Now, just our situation, we've got two individuals, they live in Holland, they have an apartment their own, they own it in Rotterdam, and then they move to Mexico. And the way Dutch law works is that it says that you are, at least the way it worked, that if you look at your net wealth or your all your investment income, if you want, you are taxed not on the actual income earned, but you're taxed on a deemed return on the income, regardless of whether you realized that return or.
A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses.
Not. So let's have a look at the treaty and see what it says. Article 6, it's pretty standard. Income from immovable property, income derived by a resident of Mexico from immovable property situated in the Netherlands may be taxed in the Netherlands. And then paragraph 2, the term immovable property shall have the meaning which it has under the law of the contracting state in which the property is situated. That's the only definition that we get in Article 6, right? And then paragraph 3 says the provision of paragraph 1 shall apply to income derived from the direct use of immovable property. So this looks fine. If we look at the Dutch text, the authentic text, it says the same in paragraphs 1 and 2, obviously, but paragraph 3 has an interesting choice of words, because paragraph 3 says the provisions of the first paragraph will be applicable to income achieved from the direct exploitation. It doesn't say use, it says exploitation. And if we look at the Mexican text, my Spanish is not very good, but at least we can recognize the text, right? Las disposiciones del párrafo 1, so the provision of paragraph 1, se aplican a las rentas, is applicable to income derivadas de la utilización directa. Okay, so which comes from the direct use of, just like the English text say. And now the question is, this English and Spanish text which talk about the use of, and the Dutch text that talks about the exploitation of, how do we reconcile these differences, because words matter, as we lawyers say. Now, if we look at the termination clause of the treaty, it says, in witness whereof the undersigned have signed this convention in two originals, the Netherlands and Spanish languages, both texts being equally authentic. I hate it when they use the word Netherlands as an adjective. The word is Dutch, but okay. And then if we look at the Vienna Convention on the law of treaties, it talks about multiple languages in treaties. When a treaty has been authenticated in two or more languages, the text is equally authoritative unless the treaty provides, or the parties agree, a particular text shall prevail. A version of the treaty in a language other than the one of those in which the text was authenticated shall be considered an authentic text only if the treaty so provides, or if the parties so agree. So it seems like we've got an authentic Mexican text and an authentic Dutch text which disagrees. We have an English text which agrees with the Mexican text and agrees with the Model Convention, but that one is not relevant, at least not under the Vienna Convention on the law of treaties. And then what is interesting is neither neither the Advocate General nor the Supreme Court made anything about this difference in wording between the two language versions of the treaty. But we still are concerned with whether fictitious income from owning real estate and using it for yourself in the Netherlands can be taxed as income from real estate under the Mexican-Dutch tax treaty. Now the first question is, of course, was this income or was this capital? Because the income tax itself bore characteristics of both, right? It was a calculation on investment income, so it's more or less your net worth kind of income that was taxed. It was a deemed fixed return and taxed at a fixed percentage. So if we look at what the court says, and I'll add the Dutch text for you below so you can have a look for those of you who read Dutch. It says Article 6, paragraph 1 and 3 of the Convention provides that income derived by a resident of Mexico from the direct exploitation, rental, or leasing of any other or any other exploitation of immovable property in the Netherlands may be taxed in the Netherlands. The term revenue and exploitation are not defined in the Convention. Pursuant to Article 3.2 of the Convention, these words in a case like this have the meaning according to Dutch law, unless the context otherwise require. And here the court is very clear, right? If you interpret a term, you go to Article 3.2. It doesn't say anything about the Vienna Convention, it doesn't say anything about the commentaries, it doesn't need to. You go to Article 3.2, that is what the treaty very clearly says. And it then goes on to say, Section 5.1 of the Dutch Income Tax Act of 2001. Now this describes as deemed income, which one pays tax on, stipulates that the taxable income from savings and investments consists of a fixed return that is calculated as a percentage of the balance of the value of the assets, including immovable property and debts of the taxpayer. That law therefore assumes that the owner of immovable property derives income from it regardless of the way in which the immovable property is used. This principle therefore applies if he purchases the immovable property to keep it available for himself and therefore does not derive any benefits in money from the immovable property. So Dutch law says nothing about exploitation. Just ownership and use is deemed to be exploitation, was what the court effectively says, right? So for the purpose of Article 6.1 and 3 of the treaty, the flat rate return must therefore be regarded as income derived from the exploitation of immovable property. So under national law, this was income and it could be taxed as such. Now there was another case where this was decided already in the Netherlands, and that was back in 2007. And the case involved Dutch residents who had a second home in France, and part of the home was financed by a loan. And the question before the court was, whether this box 3 income, as this fictitious income is called, was taxable in the Netherlands on the gross amount of the value of the French property or on the net amount, because there was also an issue of exemptions and stuff like that. And obviously if the exemption concerned the gross amount of the property without deducting the mortgage, then the exemption for the taxpayer would have been bigger. You can see the number of the case here, and in that case the court did decide this thing about whether this box 3 income is income on capital or income on income. And the interesting thing to note here is that the Mexican-Dutch treaty only covered income. It did not cover the double taxation of capital, right? The taxpayer therefore did not bring up the argument in the Mexican case, but the argument was made in actually I lied. The taxpayer did bring up the case, saying that this was capital and therefore it could not be taxed in the Netherlands. But that question was already answered in 2007 in the French vacation home. And let's have a quick look at what the court says. It says the levying of income on the taxable income from savings and investments, as referred to in Article 2.3c of the Act, as further elaborated in the Articles 5, 1, etc. of the Act, shows, as explained on the second ground in the second ground of appeal, characteristics of a wealth tax, and can therefore in certain aspects be seen as successor to the wealth tax as it was levied in the Netherlands until 1 January 2001. However, this levy of income tax on the taxable income from savings and investment is also a successor to the income tax that was levied in the Netherlands until 1 January 2001. And that is true. When the Box 3 regime was introduced, obviously the Dutch government had to say, and now we will not tax your real income on investments anymore and on your assets. We're only going to tax this fictitious income, right? And the court went on to say in the 2007 case, pursuant to Article 6.2, again, paragraph 2 of the Act, the income from savings and investments is reduced by the personal deductions regulated in Chapter 6 of the Act, insofar as they are not already in use for income from work and home. So the taxpayer in that case lost the argument that he could get an exemption on gross income, and he had to make do with an exemption from income from net income. But in any case, for us, the only relevance of this case is that it has already decided that the Box 3 income is taxable under tax treaties as income and not as capital.